Lionsgate Studios, which is a leading standalone pure-play content company. It has a motion picture group with iconic franchises including The Hunger Games, John Wick, and Shah, and a TV studio producing for every major platform, a library of more than 20,000 titles generating over $1 billion in annual revenue, as well as a talent management and production powerhouse. The company completed its full separation from Starz just before this event last year, collapsing its dual share structure into a single class of stock and establishing itself as an agnostic talent-first content supplier. The company has about 290 million shares, trading close to $14 when I just checked, so about a $4 billion equity market cap, $1.6 billion of net debt for about a $6 billion total enterprise value. We have the company's vice chairman, Michael Burns, here, as well as head of investor relations, Nilay Shah. Thank you so much for making the trip from LA to join us. So getting started, high level, kicking things off for those newer to the story, can you touch on how Lionsgate Studios has evolved over the last decade into the standalone company that it is today?
Sure. Thanks for having me. I have two questions. One, press here or no press?
We can go off record.
No, I'm just wondering whether...
There is press here, yes.
Okay, and then webcast?
It is being webcast.
Okay, great. Now I have it. I have the rules. Great. Thank you. It's going to be a lot less colorful now. Not really. John and I came over to Lionsgate in 2000, so 26 years ago. So what we tried to do is not be the smart guys, and our thesis was pretty simple. You think about our original investors. We did a very small $33 million convertible preferred. John and I put money into it. We got our friend Gordy Crawford at Cap Research, who's still on our board. He was at Cap Research at the time. They invested. Fidelity invested. My recently fired friend, Jamie Dimon, invested. And so that's the best thing, by the way, that ever happened to him. But our thesis was pretty simple, which is control as much content, buy as much library product as possible when no one was really paying attention to the library. We didn't want to bet on a particular platform or technology. We just knew as they came to us that we'd have a chance to ring the cash register with our content. So we sort of bought everything that was out there at fairly reasonable multiples. And so now the core asset that we have is the library, which is over $1.1 billion of revenue, very high margin business, which is more than 50%. And to create an opportunity for us that we would hit a lot of singles and doubles in the film and television business, but every once in a while we'd get a franchise. And so we built up the library, we built up the feature film business, and we've done reasonably well. And so it's sort of us and the majors. So the question that you all are probably asking, which is why do I buy the stock now? I've been doing this a long time, so I'm just going to try to jump into it. And the answer is timing. And we have better visibility that we've ever had in our recent history. We have the combination of new IP and franchises coming down the pipe. We also have a great number of renewals for our scripted television shows. A lot of hits that you guys probably watch. I hope you do. By the way, if you haven't seen The Studio, which is our show on Apple, it's worth seeing. Sadly, it's funny as hell and absurd, and you realize just how odd the business is that the movie and television business, the studio business is, but it's worth watching. We have had great success recently with the Michael Jackson movie. I think taking a term, I'm old, so I've been around since the Michael Milken days of the highly confident letter. I'll tell you that I'm highly confident there will be another Michael movie. There will be 2 more Housemaids based upon the additional books. We have, I think, again, you never want to bet on your favorite child, but Jim Packer was here 2 years ago, and I think he said publicly that Michael was going to be the biggest movie in recent Lionsgate history, and he was right. And I think it'll do $1 billion of worldwide box office. It's over $800 million now. So the visibility in our business is better than I've seen it for a very, very long time. And what you guys are looking for is comfort that you have the earnings power and the cash flow power over the foreseeable future. So I think right now we're in an interesting play. We're a growth story at the same time we're a value proposition. We cleaned up our capital structure, and again, I'm sort of fast forwarding. We had two classes of stock. I hated it. Most investors hated it. So we've got one class of stock now. We're trading, 3 million shares a day. We've got much more liquidity than we've ever had. So obviously a bunch of mutual funds and hedge funds and investors are looking for liquidity. We have that. We have our debt at a manageable level coming down. We have very reliable cash flows. You've got the feature film business, 12 pickups of scripted shows, a lot of reality shows. On top of that, you have the library. You've got the management business, 3 Arts we own 75% of. We like that coupled with the television business. And you have the feature film business with a bunch of franchises and new IP. So it feels like we're loaded for bear.
All right, we're done. Let's go to lunch.
There you go.
No, but let's address the elephant in the room, if I may. Obviously, a lot of little deals, one big, good old-fashioned takeover deal. Some facets to that. One, do you have the scale to compete as a buyer? Two, do you have the scale to compete in a world of dwindling streaming services? And depending in part on the answer to those questions, where does that leave you? With a very valuable library.
It's the right question. Look, do we have scale? We have scale. So we have market share in both television and feature film. I wish I could tell you there's a lot of stuff to buy. We picked off E1, and that would turn out to be a great acquisition, particularly with the Rookie franchise. Not a lot to buy, not a lot of libraries to buy, but are we big enough to stay as a standalone company? Sure, we're making a lot of money, and we should continue to make a lot of money over the next few years and de-lever. Do I think that the landscape is interesting for a lot of different things? Yeah, because everybody has the same issue, which is you want to show growth, and you only have two ways to show growth, which is organically, which is really hard to do, or inorganically, which are doing deals. So I think we're an interesting strategic partner for a variety of places. If you said, well, who would they be? I don't have a crystal ball, and I wouldn't tell you even if we were in the middle of doing a deal. But I will tell you that private equity, a lot of money, interested in doing certain things. There have been some press about that, a company that's backed by a private equity company. But do I think that's the right strategic partner? Maybe. But do I think that somebody that's got strategic synergies, both cost and revenue synergy? Yes, there's a tremendous amount of synergies with a few players that are out there. And then you've got some of these wild cards with these
sovereigns.
Well, I was going to say, well, sovereigns are one thing. They've got a lot of money, but also, and obviously the price of oil helps them. But you look at some of these AI companies with staggering valuations, but growth rate just incredible. So, we've got this strategic relationship with Runway we're pretty excited about. And it's funny, years ago I made a joke with Cristobal when we first did our a deal with him. I said, maybe someday, we'll buy you. And now he's probably, smirking at me saying, well, let's take a look at how our valuation turns out.
Yeah, that's a helpful overview as we kind of think about the landscape. Moving on a little bit to content, and I think we have this slide up here with theatrical releases. And you've clearly doubled down on some major franchises with John Wick, Hunger Games, Twilight. Can you talk a little bit about how you're balancing these tentpoles with mid-budget content moving forward?
Adam Fogelson runs our film business with his partner, Aaron Westerman. They are very disciplined on not only the overhead they have in their film group, but you have to have the right mix. The film business is art and science. You have to have the right mix of existing franchises that you feel like they're reliable and you don't have to spend as much money on marketing necessarily, and you've got a built-in audience, but you have to come up with new IP, i.e. house-made. So we'll put out, call it a dozen wide releases and a lot of other movies that are smaller releases. We've got a great movie coming out this weekend called Power Ballad. if you don't like it, if you go see the movie and don't like the movie, I'll send you your $20 back. For the people in the room, all of a sudden I'm going to get 1,000 people, but it's really a fun movie. But it's a limited release, but I think it's going out on 1,200 screens, less P&A. But it's a movie that I don't put that in the category of The Michael and The Housemaids and Resurrection, part 1 and part 2, which, by the way, I think is, and again, I don't want to go out on a limb, but I will. I think those are going to be giantly successful movies for us. And as I made a joke the other day, which Resurrection has a lot happier ending than Passion of the Christ, but maybe not for the disciples. But I would say overall, we are going to have this sort of art and science with some smaller releases throughout the year, segment 2 movies that are really good bread and butter business for us, and the wide releases. And then, as I said, coupled with the library and the television product and a television product that is doing very, very well, I like the visibility.
So
I was going to say also reinventing, I know Nilay would think I was remiss if I didn't mention, obviously, there'll be a new American Psycho, there'll be a new Saw, there's going to be a Blair Witch, and certainly Dirty Dancing. So that is existing IP that you can reboot and hopefully create another leg of upside with the entire franchise.
Mm-hmm. So diving into that a little bit more, I want to touch on the library. Obviously, has been continuing to do well over the last several years, and you've spoken about using AI to mine that longer tail catalog for incremental high margin revenue. So that's the first part. And then also I'd like to talk a little bit more broadly about AI, the impact on the content creation business and how you're leveraging that, as well as any risks you see moving forward.
We hired this new AI czar, Kathleen Grayson. She's doing great in every one of our businesses. But I'll give you an example of AI. Jim Packer, who was here, as I said, a couple of years ago, head of worldwide distribution, Jim has launched some channels. For example, there's a channel called MovieSphere, and it's a very successful channel. It's priced correctly, $5.99, no commercials, and it's basically AI is helping us, making sure. Think about the airplane that takes off with empty seats; they never get the revenue back. So Jim's got this channel which has a bunch of library product, but it also has really good titles in there that they're open for a week or 2 weeks or 3 weeks, et cetera, and bang, he fills that void. And that channel should be 1.5 million subscribers, very high margin business. It's our channel. It's using our product when it's available. And do the math, $5 a month and 1.5 million growing subscribers done for the right price point. We have a world today which is a tale of two cities. You have half this country that can't write a $500 check in a medical emergency. So Netflix has gotten expensive. And this is part of the reason that the FAST channels do so well and AVOD channels do so well, because they're free and people will subject themselves to ads and if they get something for free. But on the other side, if it's an inexpensive ad-free channel, like, for example, MovieSphere, that's a good value proposition for them. So we would never be able to do that, one, without sort of the programming that AI provides us with, because it just, it zip, 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 zip. But also, we couldn't do it without the library that we have. Mm-hmm. And I had a meeting the other day. Matt Leonetti and Brianna came in my office with Kathleen, and they showed me all the stuff we're doing in the world of AI, which is with our movie-specific shots, previewing the movie, figuring out how to budget those, again, with AI. AI is going to save us tens of millions of dollars a year.
Mm-hmm. So primarily at this point on the cost side, with a little bit of the revenue that you just mentioned. I guess, how are you thinking about IP protections as these tools become more capable?
Again, if you own the underlying IP, then you have protections built in. You have Sora that came out, and all of a sudden everybody was stealing everything, and then that sort of got shut down. We like the idea within a certain I'll call it playpen or sandbox, where people can work with our IP if there's a way for us to monetize it in those scenarios. So AI is, look, it's like Moore's law on crack. It is going so fast that again, if you own the existing IP, you get a lot of different ways to monetize it. So I think it's exciting on both.
If the law works.
What's that?
If the legal protections.
Yeah, I think they will. But again, actors' likenesses, with cooperation, I think that there's a participation with them. Again, if everybody can monetize it together.
Okay. And then just touching on TV segment performance and expectations moving forward, I've kind of alluded to it, but just touching on kind of what you're expecting there and the sustainability of renewal run rates from here.
Here's what I think. I think that we have an unbelievable television business, but it's a bread and butter business. It's a sort of low, on a normalized year, it's a low double-digit margin. However, all those shows eventually come back to us. For example, I know Mad Men recently came back to us, and so we relicensed that to HBO. We have a big title coming back to us, one of Netflix's biggest hits, which was for us, which was Orange is the New Black. That comes back to us. So on the years that you have, your bread and butter business, your normal renewals, Kevin Beggs got 11 of the 12 scripted shows renewed, and that's great, and we make money on every season. However, when you have something that comes back and you've got 60, 70, 80, 100 episodes, and then you're relicensing them again, that's when the margins spike tremendously in the television space. The idea that content's coming back to us, we bought companies over the years and libraries, and one of the big acquisitions we did years ago was Summit. Summit has great library titles, and all those Twilights that they licensed out the first cycle, Twilight 1, 2, 3, I think there were 5 of them, they're all coming back to us. So, we had original projections. We said, oh, it's going to come back in France. We licensed it, I'm making this up, for $5 million for a 10-year, 12-year license. Summit did that, comes back to us now. You'd say, in the past, well, it was $5 million for a cycle. It'd probably be a discount to that, $3 million. Well, now it's a multiple to $5 million, and the term is a third of what it was the first time around. And if you want to know why that is, there are 3 explanations: Apple, Amazon, Netflix. So those people that are licensing our content are looking for world-renowned content brands that they recognize, and we're in a good place on that.
Maybe you could talk a little bit about 3 Arts. Just explain to the broader audience what that is and how it fits, or maybe it doesn't fit.
It's a management company that works very well with particularly our television side of the business. By the way, they manage the director for this big hit that just came out, Backrooms. So again, it's a commission business. They're charging X percentage, call it 10% of their clients' income, and they're out there hustling. They've got less clients, so meaning that agencies have a lot of clients, and so you could be an agent and have 100 people. They're very specific on who they take as clients. They're great in packaging television shows. What 3 Arts, why they like us, is by partnering with Lionsgate on a lot of these television shows, like, for example, Hunting Wives, you just get much better economics with the studio definition that comes from Lionsgate. So that deal has been great for us and great for them. We own 76% of it. We may own 100% of it down the future. We may own less. So just stay tuned on that. But we do like that business.
Strikes me in that conversation, by the way, Backrooms came up in an earlier session, that you're actually relatively well-positioned versus other studios that own big lots and have lots of capital. You're really a capital-light business at the top of the stack.
Yeah, the studio, these giant overheads. If you look at our television and our feature film business, it's a fraction of what everybody else is. We don't see the point in owning all that.
Yep.
And you become a captive. We have some stages because we want to make sure we have them. We've got a great deal in New Jersey. We've got some stages that were in Yonkers, and so as long as the subsidies are there, we're going to shoot a lot of product there. We're doing some stuff overseas as well.
Right. Now, that I guess brings up capital. You mentioned Michael and Milken earlier. You're a little over 6 times leverage today. You've got a path organically to, I think your target is 4 to 4.25, something like that. Yeah. Maybe we could just talk a little bit about, maybe it's too early, but what next after that?
Well, I think you're gonna see the trajectory going down when you spend a ton of money on content and P&A and et cetera, and that's gonna go up. But we're certainly much more comfortable getting to a level of, call it 3.5 times. We don't want to be over levered. That's a death spiral for anybody in our business, and so we like the trajectory of that. We've invested $20 billion plus in content that we're going to be mining in perpetuity.
I guess we touched on it a bit at the beginning in terms of the stock price moving up significantly more recently. Business is seemingly at an inflection, with the most recent fiscal year being more of a transition year. Looking ahead to the next fiscal year, slate's loaded, leverage coming down. I guess anything to highlight for investors or catalysts that we should watch out for before we kind of move to audience Q&A?
Let's make Nilay sing for supper. What do you want to highlight, Nilay?
Yeah, I mean, look, I think that the biggest thing that I took away as we were getting ready for the call and just thinking about how we were going to message, the future, is really that fiscal 27, right? Because we started our fiscal year on April 1, is not just about Michael, and it's not going to be about any one film. We are sitting here today talking about a multi-year growth story, right? And I think the studio business, the Achilles heel has always been the product cycle, right? Is it a Bond year? Is it not a Bond year? Is it a Spider-Man year for Sony? Is it not a Spider-Man year? And I think given the visibility we have, we really think that this is a multi-year EBITDA growth story. And I think that combined with the free cash flow story and the deleveraging story really makes this not just about the product cycle, it's about the library, it's about the sustainability of the tentpoles, it's about the IP and franchise that we talked about. And so we really feel confident that we've turned the corner, and this is kind of be the inflection point story that we're talking about. And obviously, Michael referred to strategic optionality as well. And so we really feel like we're probably better positioned than since I've ever been at the company, since 2021. But I think you could even look back further and say, wow, they've really laid the groundwork for all parts of the business really accelerating. So we feel really good about the business.
The takeaway is the separation really worked. Took us a long time, and many of our shareholders, or long-term shareholders, were very patient. But boy, oh boy, that was painful to collapse the A and B shares the same time you're separating Starz and Lionsgate into 2 separate public companies. Starz has had a good run, and I'm involved in Starz. I'm on the board there, actually chair and non-executive chair. But Jeff Hirsch and his team have done a great job there. The show Fightland, by the way, from 50 Cent is gonna come out, and that's a very exciting show for them. So I feel like there's no doubt that the separation worked. All you got to do is do the math. What you've got X shares of Starz if you were a Lionsgate shareholder, and you've got a share of Lion. So we're pretty excited that what our thesis was by separating the businesses was the right move.
So it was worth the wait. Some left in the tank. What's the money back guarantee movie again?
Oh, I think Resurrection's going to be a giant.
Power Ballad.
No, yeah, Power Ballad.
Power Ballad.
Power Ballad. You can watch. I think it's like 100% on Rotten Tomatoes. It's a really fun movie with one of the Jonas Brothers. Which Jonas brother is it?
Nick Jonas and Paul Rudd.
And not that I could name the other ones, but Nick Jonas and also Paul Rudd. It's about the stealing of a hit show. It's very, very good. I'd be shocked if you didn't like it.
All right.
But it's not a huge release for us, but it's a good business for us. We've got another Jason Statham movie coming out later on, which are
Mutiny,
which are moneymakers for us because his audience always shows up.
There are worse things to do than follow studios and soccer teams. So appreciate you being here.
Yeah,
Both
you're
of you,
in the
Nilay
fun
and
business.
Michael.
For sure. It's a lot more fun than following healthcare.
Definitely agree with that.
If you guys have any questions, you've got me for
sure
5 more minutes, please. Anybody? No. Nilay's really smart.
On certain topics, maybe.
Exactly.
We've got stars coming up later, so save the.
Oh yeah, Jeff will be here today, which I think it's worth seeing. He's, as I said, he's doing a really great job, and he's got a very good niche audience for which are underserved women, African Americans, and it's a pretty exciting story for him as well, and real cash flow. And then I think we're going to pay attention to our cash flow going forward, and pay attention to the trajectory of our earnings.
Actually, we do have a question.
Here we go. Kind sir.
Thanks so much. Has the cracks in the private credit world changed your perception of your ability to buy content in 1 to 2 years from now?
To buy content, you mean libraries?
Yeah, there's been a lot of. It feels like that world, the rise of the private credit world gave rise to kind of irrational bidding on certain assets, including in the content world, and so
Music libraries, I think he's maybe talking about.
Yeah, I think that we're opportunistic on the timing of when we buy libraries and who we buy them from, but we've had great success. That I'm not going to, disparage them, but we like buying libraries from institutions that really didn't know what they bought in the first place. So, and yes, it gets frothy and people spend a lot of money, and then they ultimately say, wait a second, this really isn't a core asset for us, but it is a core asset for us. So we're hoping that some of that stuff shakes loose. There's just not a lot of it out there. With 20-some thousand titles in the library, we certainly have a core asset that has scale.
Yeah, I think the music library business is just a lot more fragmented, right? And it's on an artist by artist basis in a lot of cases in terms of what deals are happening. As Michael alluded to, the media business, it's the opposite of fragmented, and so that's why our asset is so scarce. And E1 was kind of this really unique opportunity. There just aren't that many out there. Right?
Here's a question for the audience. To talk about throw back to libraries and the way these work together. Who was the #1 artist on Spotify streaming last week? Michael Jackson. So the way that these feed off each other is really terrific. So that movie, not only great for us and everybody involved with it, but certainly the Michael Jackson estate and catalog.
Oh, bank.
Can I just yell it out?
Yeah.
Go ahead.
Could you just explain the accounting behind when you relicense an existing portfolio, the incremental margin?
I'm glad you asked that question, because here's how ridiculous the accounting is in the film and television business. When we release a movie, we have to write it down to 0 in 10 years. So our book value of that product is 0. So, and most of it is in the first 6 or 7 years, actually before that. So, but anything that came out 10 years ago, there's no quote value on our books. So, the margin's pretty good.
I mean, there's still participations that you have to pay, but generally speaking,
when I mean margin's pretty good, I mean, typically certainly more than 50%. Yeah. But you think about it, you've got residuals, call it that 7-8%, and then on top of that, some participations. We're also very active. Brian Goldsmith, who's our chief operating officer, is an animal. He spends a lot of time buying out participations, because if the math works for us, and it's great if a participant wants to get money early, we're all ears with a checkbook to buy out those participations going forward. Good for them, good for us.
All right, we're going to go to lunch on an accounting question. You must see a lot of movie pitches. You've gotten that down. You're pretty good.
Yeah, I've seen a lot of movie pitches. I'll tell you one final joke, which is hilarious, because at least it was to me. My 13-year-old son said, "Dad, how long have you been vice chairman of Lionsgate?" And I said, 26 years. He goes, "Why can't you get promoted?" Thank you all.
All right, thank you, everybody.
Thanks, everyone.
Christopher Morangi is president and co-CIO. Sergei Luzhevsky, Hannah Howard, Gustavo Pafano, and Alec Bacanfuso are portfolio managers. Justin McAuliffe and Jenny Moo are research analysts at Gabelli. The above webcast is an excerpt from Gabelli Fund's 18th Annual Media and Entertainment Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of March 31st, 2026, affiliates of GAMCO Investors, Inc. beneficially own, on behalf of their investment advisory clients or otherwise, approximately 31.2% of Atlanta Braves Class A and 5.4% of Class C, 11.3% of Sinclair, 5.8% of EW Scripps, 5.2% of Madison Square Garden Sports, 4.7% of Sphere Entertainment, 3.3% of Manchester United, 2.9% of Madison Square Garden Entertainment, 2.6% of Gray Television Class A and less than 1% of Common, 2.2% of Ryman Hospitality, 2.0% of Liberty Global Class A, 1.1% Liberty Global Class C, 1.4% of Versant Media, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI.